Welcome to The Explainer. Today, we're strapping in for the absolute economic roller coaster ride of Indian amusement park giant Wonderla Holidays.
Okay, here's our roadmap for today. 1. The business of fun. 2. Weathering the recent storm. 3. The financial impact. 4. Aggressive expansion plans. 5. Wonderla versus Imagical World. And finally, 6. What lies ahead? Let's get right into it.
Section 1. The business of fun, the industry climb. To really understand Wonderla's strategy, we first need to look at the massive momentum behind the sector in India right now. The underlying demand is literally huge. Sharekhan research points out that while India currently makes up only about 1% of the global theme park market, things are changing fast. Rising per capita income and a big push for domestic tourism are driving an expected 10 to 11% compound annual growth rate over the next 4 to 5 years. The demand is absolutely there. And when you're evaluating these parks, the absolute crucial metric you need to know is ARPU, average revenue per user. See, getting visitors through the physical gates, that's really only half the battle. The real scalable profit comes from what they buy once they're already inside. Food, fast passes, merchandise, that non-ticketing revenue is basically the holy grail of the amusement park business model. Section 2. Weathering the recent storm, the unforeseen drop. Because, even the most thrilling roller coasters have steep, stomach-dropping descents. And for Wonderla, the second and third quarters of fiscal year 2025 were a really harsh drop. Footfalls absolutely plummeted recently, and it was due to a perfect storm of unavoidable environmental and macroeconomic factors. We're talking severe floods in Andhra Pradesh and Telangana, highly unpredictable landslides in Kerala, adverse weather and health scares in Bengaluru and Kochi. All of this compounded by a broader dip in discretionary consumer spending. This whole situation dragged down like-for-like attendance by almost 14% in quarter 2 alone. And the narrative is clearly proven in the data from ICICI Securities. Quarter 3 saw an undeniable 15% drop in footfalls, which then directly resulted in a 13% hit to total revenue compared to the previous year. I mean, you simply can't outmarket extreme weather, right? Section 3. The financial impact. A steep margin plunge. So how did all these environmental challenges and lower footfalls actually translate to the balance sheet? Well, the impact was staggering. Wonderla's adjusted EBITDA margin completely collapsed to a mere 1.2% in quarter 2. That is an absolute shock to their short-term profitability, especially for a company that's totally used to running highly efficient operations. To really understand the full damage here, just look at Q2 alone. Margins contracted by a brutal 26 percentage points year over year. Why was it so drastic? Well, because alongside those lower revenues, they had heavily increased their marketing expenses, launched a brand new park in Bhubaneswar, and ramped up corporate recruitment efforts to support their future growth. So all those fixed and strategic costs just heavily dragged down margins when the actual footfalls didn't materialize. Section 4. Aggressive expansion plans, building the next loop. Creating immense narrative tension here, management is basically ignoring the short-term storm and doubling down on a massive, heavily capitalized growth loop. They definitely aren't retreating. Operations just commenced at their Bhubaneswar park. Their new Chennai park is actively under construction and fully on track for late fiscal 2026. And beyond that, they're already engaging states like Gujarat, Madhya Pradesh, and Punjab, aiming to open 3 to 5 more parks right across India over the next few years. Of course, building new theme parks is incredibly capital intensive. This master plan requires an aggressive capital expenditure of up to 2,000 crore rupees over the next 5 years. To fuel this, the board has approved an 800 crore equity fundraise expected by the end of fiscal 2025, and they're going to lean on debt and internal cash flows for the rest. To ensure these new parks actually hit high profitability, they're executing a strategic shift to international standards. They want to move their current 72 to 28 ticketing to merchandise ratio down to a highly lucrative 60 to 40 split. How? By rolling out totally new food and beverage menus, pushing branded items, and tying non-ticket purchases directly in with the park tickets. Section 5. Wonderla versus Imagical World, the rival ride. Now, Wonderla isn't the only park in town, so let's see how they stack up against their primary rival, Imagical World. According to data from Trendline, the two are virtually tied overall with a score of 19 each, but they win in very different areas. Wonderla absolutely dominates the fundamental and shareholding metrics, winning 11 out of 15 fundamental categories. On the flip side, Image a Girl World takes the crown for price momentum, technicals, and broker targets. And this brutally highlights the current divergence between the two. While Wonderla suffered a near 98% quarterly net profit wipeout year over year due to those specific regional weather events we just talked about, Imagica World managed a 49.2% surge in quarterly net profit over that exact same period. Yet despite the recent operational battering and margin compression, Wonderla maintains a commanding lead in institutional trust. They currently hold 16.7% institutional investment, compared to Imagica World's 2.6%. It seems the big money still really believes in Wonderla's core fundamentals and their history of a zero-debt balance sheet.
Section 6. What lies ahead? Long-term momentum.
So as we pull back into the station, what are the financial analysts saying about Wonderla's long-term momentum? Well, impartially looking at the calls, both ICIC Securities and Sharekhan maintain positive ratings despite cutting short-term earnings estimates. ICIC maintains an ad rating with a target of 790 rupees, expecting growth to aggressively return in fiscal 2026 and 2027 as the Chennai and Odisha parks scale up. Sharekhan maintains a buy rating with a 991 rupee target, pointing to the underlying 10 to 11% industry growth rate and Wonderla's massive push toward a more profitable ARPU.
Leaving you to ponder this final takeaway from our explainer today. As Wonderla bets a massive 2,000 crore rupees on the future, can their aggressive geographic expansion and ARPU optimization outrun the highly unpredictable environmental headwinds to secure lasting dominance in India's booming theme park industry? That is the multi-million-dollar question we'll be watching closely. Thanks for learning with us today.